Hi everyone, welcome to the video presentation, A Tour Around the World. This particular presentation was delivered before a live audience in November of 2016. The presenter was Jean-Philippe Brie, global strategist with Signature Global Asset Management. We had asked JP to talk to our clients because of the extraordinary events, both economically and politically, that have been taking place over the last year. Two of the major events were, of course, the BREXIT vote, where the United Kingdom voted to renegotiate their relationship with the European Union in June of 2016, culminating with the election of Donald Trump to be the President-elect of the United States. Clients have had many questions about the political, economic, and social impacts of these sweeping changes that are impacting the globe, both politically and economically. JP provides us with an overview on these changes and how it will impact investors and capital markets. I know that you'll find his comments insightful and helpful as you try to make sense of these global changes around us. So my name is Shaun Humphries. It's a real pleasure for me to welcome all of you to tonight's event. And on behalf of the advisors of the Santi Advisors Manitoba region, we were really looking forward to hosting this event. We think it's timely, and when we know that our speakers are going to provide you with some great insights, some education, some information that'll hopefully give you a better perspective on what's going on around the world in terms of the transitions and changes that are going on. When you think about it, 2016 has been an absolutely extraordinary year, and so all I have to do is say Donald Trump President-elect, and that gives us a sense as to just how surreal the year's been. We go back into June of 2016 and another event that took place which no one really was anticipating. They thought the vote would be close, and that was the Brexit vote. And so most pundits and analysts thought that the UK would vote to stay in the European Union, and now they want to renegotiate the economic aspects of that union. That was a really big surprise. We see events in Europe, particularly a concern around migration and the impacts to various countries and how countries are struggling with that, and leading to a little bit of change and challenge politically in the European Union. And some of those concerns have just hit the shores of North America. So some pundits think that what's happened with the election in the States is really a reflection of a lot of the concern and anxiety that's going on in Europe today. So there's no doubt that there's tremendous change going on. And as we go through these winds of change, we look at the past and we know that change is always present in the world. That's just a matter of fact. But there seems to be this sense that change is more prevalent, it's more hyper, it's quicker, and there seems to be broader sweeps of change around the world that we need to contend with. And so tonight, what we want to do is to give you a bit of perspective on the linkages between change and maybe the impacts around economies, capital markets, social changes, political changes. One wise pundit said, when life changes, money changes. When money changes, life changes. It's pretty hard to sort of separate those particular issues. So again, we want to thank you for taking the time for joining us tonight. Well, what I'd like to do right now is introduce you to our first guest speaker, and I'm going to, I'll say Jean-Philippe Brie, but I'm going to use a short form, if you don't mind. JP, Jean-Philippe, and so JP is Vice President Strategist of Signature Global Asset Management. They manage, believe it or not, $55 billion of assets, and JP has just a great sort of background, a depth and breadth of expertise that he'll be able to bring to the presentation and give us some insights. He started his career in the financial services industry in 1989, and before that, before he joined Signature, he was an international portfolio manager with McLean Budden and a global portfolio manager with Amundi Asset Management in London, England, and a global financial portfolio manager with Amundi Asset Management in Paris. So if you can join with me in giving JP a warm Winnipeg welcome, that would be great.
Well, thank you, Shaun. Thank you for Asante for having me, and thank you all for being here tonight. I hope we can have an instructive few minutes together, And as you see from this, this slide, you might have thought that I just put this together just after the election. But in fact, this is something we've had for a while now. And so I'll go into that reasons or why we had this regime change. First of all, what it means, what obviously the Trump presidency means, and when I talk about what it means, I'll say it means for markets, and talk a little bit about Europe, talk a little bit about around the world, and get your questions. So I'll hopefully just speak for about say 35 minutes or so, and then and take your questions. But regime change for us, and I better speak into the mic here. For us means that there's a change from a period of deflation to a period of slight inflation. And you have to recognize that since the crisis, the great financial crisis of 2008, we have had persistent deflation, which means that interest rates, as you are maybe aware, have regularly and significantly come down, persistently come down. So if we look at forward, I'm going to go through these slides now and then because this is sort of to illustrate what we think is going on. But this is these are 10-year U.S. government bond yields, and what it shows you is that for 35 years they have been coming down, and in fact they hit their low point just after the Brexit vote. So in other words, on this chart, on the 10-year government bond, we hit 1.37%, which is actually lower than it was at the height of the crisis, which is pretty hard to explain, right? Because the economies haven't been that bad. And yet, this is what the deflationary pressures were doing. Now, we were saying we were going through a period at the end, we were at the end of this period because what we saw after the Brexit vote was, in fact, a move into equities. We saw that, in fact, governments were finally starting to look towards fiscal policy for the first time. So for instance, in the UK, the austerity measures that the UK was looking to keep said, we're done with those austerity measures. We're going towards fiscal policy now. And what happened was that they lowered interest rates yet again in the UK after the Brexit vote. And then what you had in the election campaign in the United States is both candidates talking about fiscal policy. And so since the crisis of 2008, we have relied almost exclusively on lower rates and monetary policy, meaning basically central banks policy, to try and stimulate the economy. We have had virtually nothing from the fiscal policy in governments. And in some respects, I think you can accuse a lot of governments for being very neglectful with respect to, neglectful or maybe not competent in terms of not looking towards other measures to try to stimulate the economy. So this is what we're seeing. And of course, this, at the same time as we kind of abandoned austerity in the UK, we talked about fiscal policy in the US, we were also getting the end of austerity in Europe. The Germans for the last several years have talked about austerity to try to balance the budgets in Europe, and that was also abandoned. So that was the reason we were saying that things should improve. And should improve and should lead to the end of this deflationary cycle. Now, we did not expect Trump to win. We expected Clinton to win, and Clinton to to keep going on this path at a very slow rate. But what does Trump do? And first of all, maybe before we do that, let's just talk a little bit about Trump and why he probably won. And to recognize that he won really thanks to a few states that are not far from here, and Wisconsin being the first one, and Michigan being another, and Pennsylvania being the other. And so let's just take a look at why Trump, I think, won. So this is the Bernie Sanders chart, which is obviously the other phenomenon in this campaign. He was also an outsider and coming obviously from the left. And what you see in this Bernie Sanders chart that he was putting up in his campaigns was essentially what was going on between the rich and the poor in the United States. And what this shows you is that the red line there is the S&P 500 and how it's risen since 1980. And on average, it's gone up about 7.6% per year, and with the ups and downs on average. So if you've had capital to invest, you've actually made about 11 times your money if you've put it in the stock market since 1980. On the other hand, if you didn't have any assets and you were the median family in the United States, your wages went up 0.3% per year. Clearly, those people have been left behind. A lot of them have been left behind. And the result in the United States is this. And now, this is true of all Western nations, but the United States is the most pronounced of any of the Western nations anyways, whereby 80% of the wealth is now held by 10% of the population. And 50% of the population now own less than 5% of the wealth. That means that for 50% of Americans, it represents the collapse of the American dream. And the social mobility, in other words, the ability to be able to go from poverty or from being poor to actually making it, is actually considered now the least probable in the United States versus any other Western nation. And part of the reason for that, I would argue, is education. The education system hasn't followed. But that is, however you want to look at it, that is today's reality. And the United States obviously is the worst of, I mean, again, it's true of all Western nations, but it's especially true of in the United States. So now, why have markets done so well since Trump? Well, part of the reason is very similar to Brexit. Brexit, you know, if you may recall, the markets actually went down substantially and then recovered very quickly. And part of the reason is that Brexit is a crisis of it is a form of crisis, admittedly not, you know, it's a smaller country, but it's a form of crisis to Europe. And we'll talk about Europe a little bit if we have some time. But essentially, we don't really know the impact of Brexit for another few years. Life just went on as it was the day after the Brexit vote. And we won't know what the full impact of Brexit will be for another few years. Well, I would argue it's the same thing with Trump. We will not really know the full impact of the Trump presidency for another few years. But here's what we do know today. We know right in his victory speech what he said. He said, we're going to rebuild our bridges, we're going to rebuild our tunnels, we're going to rebuild our schools, and we're going to rebuild our infrastructure. Now, why is that important? Well, that's important because, sorry for moving around, but infrastructure has been completely left to the side in the United States. Historically, they've invested between 2 and 3% of their GDP in infrastructure. And a couple of years ago, it went down to 1.5%. They have completely neglected their infrastructure. And when Trump says that going through JFK, which is the New York airport, is like going through the third world, he's not exaggerating. It's a very, you know, you compare those airports to modern airports in China, it's another world. So again, this is where, of course, you can also help, you know, the bottom end of those 50% by providing them with jobs. So here's one of the things that Trump said that is obviously positive for stimulating the economy. The second thing that he said is that they want tax reform. Now, one of the reasons that the market's somewhat excited about this is because for the first time in 8 years, the United States actually has a chance of actually getting some legislation passed, because Trump and the Republican Party control the 3 branches of government: the Senate, the Congress, and the House of Representatives, and the presidency. Which means that there's a likelihood, or a strong likelihood, that these measures will be passed. Obama has really only been able to pass one signature legislation, and that is Obamacare, the Affordable Care Act, which is probably going to be repealed or changed dramatically. We'll go into that in a minute. So essentially what Trump has is the ability now to have some infrastructure spending. And remember, his infrastructure bill or proposal is significantly higher than that of Hillary Clinton's was. He's asking for $1 trillion over a number of years. It'll likely be less than that, but nevertheless, still much more than what was initially expected. That will stimulate the economy, and that will help a lot of companies. The second thing Trump wants to do is reform the tax system. Now, the US tax system has not been reformed since Ronald Reagan. That was 35 years ago. Now, there's been a lot of loopholes that have been added, special interests that have added their little niches of tax cuts. So the effective tax rate for a lot of companies is relatively low, but the real tax rate, or the official tax rate for corporations, is 35% in the United States. That is the highest in the Western world. In Europe, it's around 25. In Canada, it's around 25. So they can reduce this. And who are going to be the beneficiaries of this? Well, the beneficiaries are going to be small businesses. Most companies in the United States, small businesses, they have two sets of books, one for the government and one for themselves. Because the government's going to take 35% of it. It's hard to escape. You're not Apple that can go and set up operations in Ireland. Obviously, it's going to help other companies too that have to pay the taxes. A lot of the companies in the United States have been going offshore, obviously to produce offshore to lower the cost, but also to go and just get lower taxes. So Pfizer, which is one of the largest pharmaceutical companies, tried to buy Allergan, that's based in Ireland, because it wanted to locate there so that it could have the Irish tax base. Irish taxes for Irish earned income is 5%. It's pretty low, right? So this is the sort of thing that's going on today. So now by reducing this, you are going to help a lot of companies that before weren't able to, that were looking to minimize taxes in other forms. Now obviously you have to get rid of the special interests, you have to get rid of the loopholes, you have to simplify it, the measures and everything else. The other thing he wants to do is roll back some of the regulation. Now some of this is controversial, like the Dodd-Frank, which is essentially there. Dodd-Frank is legislation that was brought in after the crisis to essentially not prevent, but to mitigate against banks going bankrupt. Because banks today are too big to fail. They still are too big to fail. And what does that mean? That means that if they fail, the taxpayer has to bail them in. And that's what happened in the US and under TARP. TARP was essentially to recapitalize the banks with taxpayer money. Now the taxpayers did get reimbursed, just like they did when the government bailed out General Motors, when they bailed out Chrysler, when Reagan bailed out Continental Illinois. So this has been a bit of a pattern. But after the crisis, obviously there was a lot less appetite for taxpayers to actually go and bail out banks, and we can understand why. So what the government's decided to do, either you could bring back legislation that would separate the banks, the risk-taking banks would be investment banks from the commercial banks, but instead what they said is that we're just going to increase the requirements of banks. In other words, raise their capital ratios, increase their capital so that they have some more ability to absorb losses, and then limit their ability to take risk. So if you roll that back, or roll some of that back, banks will now be able to take more risk. And some of that will mean that banks will be more profitable. And most of the times they are, until they aren't. Until something happens, like crisis. So somewhere, in the short term, this is going to be positive for the banks. Now you can question the morality of it, you can question, the wisdom of that longer term, and I would question it, but we'll have to see exactly what they do, but from a purely market perspective, that is positive for banks. The other thing that he wants to do is roll back all of the environmental regulation that Obama has passed through regulations and through actually the back door, because he hasn't gone through legislation to do this, he would never have gotten it through. But he wants to adhere to the Paris Climate Agreement, that's Obama. But obviously Trump has made it clear that he wants to roll that back. Now that has other implications. Again, longer term, it's not necessarily the best thing. I mean, the United States is one of the largest polluters in the world, certainly the largest polluter by far on a per capita basis. And if you don't do something, if the United States isn't on board to actually limit those, then you really can't get agreement worldwide. But what that does short term, or rather in the medium term, is that it will set the United States on a much better competitive foot, because they will not be beholden to a lot of the regulations and the taxes that are imputed on other countries, in other countries, including Canada. So by way of example, Germany today gets 25% of its energy through renewable energy, and it's going to 50%. But there's been a huge cost to that. The electric bill of consumers in Germany has gone up 5-fold. Companies haven't been as penalized because they didn't want to make them uncompetitive versus foreign peers, but nevertheless, they have not benefited from the lower energy prices. The United States has and will. Same thing in Canada. We're rolling out some major legislation in terms of carbon taxes and other measures that really will increase the costs, but actually will put us at a competitive disadvantage to the United States if those regulations are rolled back. So all of a sudden you have a picture here where the United States actually looks pretty good. And a lot of the sectors that were before being penalized, like financials, because they had those regulatory headwinds, because they had the taxes, because they had the politics against them, all of a sudden are being reversed. And of course, what all this means is that also where they're being advantaged, or some of these financials, is the fact that interest rates have been going up. So interest rates on the long end have been rising. And what that means is that banks make money off of what they call a spread between the short rates and the long rates. They borrow short with your deposits, where they pay zero, and then they lend longer. And when the rates go higher, well, then they make more money. And because recently they've been going higher, they've made more money. So there you see how this is shaping out. It's shaping out to be a much more positive outlook for a lot of these sectors. And then the one I didn't mention, obviously, is the repeal of Obamacare. Now we'll see if they actually do this. Our specialist, Jeff Elliott, thinks that they will be able to come up with some sort of compromise to find ways of basically handing some of this to the states as opposed to the federal government, which makes some sense, frankly, because it's such a big program to be managed centrally by a country as large as the United States probably is not that efficient. It's probably just too big to actually work properly, and having it managed by the states probably makes some sense. But they have to find some way of getting those 20 million people that were previously not insured and are today insured thanks to the Affordable Care Act to have some sort of replacement. But obviously the question is on the pharma is, will they actually have restrictions on price control or some form of price controls on drugs? So I'm not sure if many of you are aware of this, but one of the things that in the United States is once you hit 65, you can go on Medicare, and essentially George Bush actually extended Medicare to include drugs. And so prescription drugs were added to it. And so Medicare today in the United States is actually the largest buyer of medicine, of drugs in the United States. But when they did that, the Congress at the time also said that Medicare is not allowed to negotiate with the drug companies to get lower prices. So if you think of there's one area where the American taxpayer is really getting screwed, it's really on the drugs, right? Because if you have drugs, even compared to Canada, you know that we're paying quite a bit less because we negotiate, right? And we don't negotiate as well as France or Germany does because we don't have as many people. But I can tell you, I lived in France, and drug prices there are half of what they are in Canada. So you can just imagine what they are. So we'll have to see exactly what he does. And I think this is kind of what the next phase of what I want to talk about here now is we'll have to see exactly. I've talked about the good things, and I've talked about what he's said so far that has a good chance of actually happening because of he has control over those three legislative branches, or three powers that he has. But there are some big uncertainties. The big uncertainties with respect to what is he really going to do in international trade. And obviously, he may open up NAFTA and try to renegotiate. He's already said that he would like to, in the campaign, talked about adding tariffs. Now, this brighter picture that I was painting could reverse on a dime if Trump decided to get into some sort of trade war with China, where he would raise tariffs. And in fact, the Chinese have kind of preempted this earlier this week by saying that if the U.S. puts tariffs on some of our products, we will do the same to American products. In addition, we will cancel orders to Boeing that are in the billions and go towards more Airbus. We will cancel our orders in grains and cereal that gets imported from the United States and go to Canada, Russia, and Australia. And we will put tariffs on U.S. cars sold into China. So they will hit where it hurts. And if you think about this, and why, and the reason it's unlikely to happen is because this is the way we started in the 1930s. In the 1930s, essentially, the Depression came because of trade wars and people putting tariffs and then other people doing the same thing. And of course, where it really doesn't make any sense to do that is that if he puts a tariff on anything, it just means that the price at the Walmart is going to go up by that percentage. So you're going to penalize your consumers with a form of tax. So it really makes no sense to be doing that. And which is the reason I think the markets for now don't think it's actually going to happen. But there's other issues here that are going on, I think, from a geopolitical point of view. And it is the fact that the United States has already declined in terms of its position within the world. After the fall of the Berlin Wall, it really became the only superpower. And the relationships that it had and developed over the 70 years since the end of the war had been reinforced. In other words, the world depended on the United States for writing the rules of trade, being the world's global policeman, and understanding the rules of the game that were more or less, pretty much formulated and originated from the United States. And that position has been declining. It's been declining partly naturally simply because the influence of the United States is not as great diplomatically, and it's not as important economically. There are other countries in the world, like China, that are growing more rapidly and are becoming more important geopolitically. And just politically, you can talk to a few of events of where the United States has really diminished its credibility. Now, if you remember, there was a red line in Syria, that if they use chemical weapons, that would be the red line, where conceivably there would be measures taken against Syria. Well, that didn't happen. They used the chemical weapons, it didn't happen. When the Russians invaded Crimea and took over Crimea, the Russians were told, if you go into Ukraine, that's our red line. You don't go into Ukraine. Well, they went into Ukraine. And that wasn't a red line. So the credibility of the United States has diminished. And the fact that they want to now eliminate or back away from TPP with a Trans-Pacific Partnership will be another chink, if you want, in the armor of the U.S.'s hegemony. Because TPP is really, a lot of it is really about Asia and who will continue to write the rules of the global game, or the trading game, or the relationship game in Asia. And if they move away from that, the Chinese will be in there like a hawk. And though that TPP will be replaced with some form of free trade agreement with China that the US will not be a part of. So tomorrow, Abe, the Prime Minister of Japan, pushed himself onto a plane to go and meet Trump. And he is going to tell him exactly that. He's going to tell him that, not only are you putting your security and your position in the world at risk here, but you're also putting ours. So, and I would say that, this is just in terms of where China is going. They have a much more stable political system right now. The system is a lot more stable, with a leader being just named a core leader. It hasn't happened since basically Mao Zedong and Deng Xiaoping. So he's consolidated his power. The country is transitioning from basically a major investor in fixed assets to being more services. There are parts of Shenzhen that have, in other words, just north of Hong Kong, that are like the Silicon Valley of China, that are booming with incredible entrepreneurial capabilities. Our CIO, Eric Busher, was there last week. We had a long conversation about what is going on there, and it is absolutely, it's extremely dynamic. Now, there are problems in certain parts of the country where there's overcapacity in steel, in aluminum, and other areas, and that's a problem, especially in the Northeast. But there are other areas that are really, really booming. And if you see what they're doing, in terms of the growth, in terms of integrating the Tier 1 and Tier 3 cities. Tier 1 are the biggest cities with often 20 million more people. Tier 2 are obviously a little bit smaller, and then Tier 3 are somewhat smaller, but they are using a full network of high-speed trains that are basically similar to what a metro system is. So you can, and he says they're pretty cheap. So he went for a 300-kilometer ride in a little over 2 hours. That cost him $10. And not only that, but he had 4G network on the system. So China Mobile has 850 million subscribers. 500 million of them have 4G. And 4G, between 3G and 4G, is you get your information that much more quickly. So this is the kind of competition that we're on a global basis that the United States now faces. And so its position is weaker. And so I think in terms of Trump, we're going to have to see really how he acts and how he behaves even internally to the heightened political risks that now exist in the United States. Because obviously there's more heightened political risk in the United States just by virtue of this massive divergence of opinion. between the right and the alt-right, and then the left, and I would say the more extreme left. And the fact is that depending on his words, that could have an impact. It could have a negative impact on what happens there. So, anyways, let me go on a little bit and talk. I'd like to talk a little bit about Europe just quickly, and tell you because Shaun mentioned it earlier. And part of the problem in Europe is this. I was talking about how banking system was improving in the United States, but actually it's not improving in Europe. The problem in Europe is that they never recapitalized their banks. They never got the public money to really make an inflow. And a lot of the Italian banks, for instance, are still wobbling. And it's taken years to try and settle this. We think they'll eventually get there, but this is one of the issues. The other issue with Europe is that it's simply structural. You have a currency that is too expensive for some and too cheap for others. So just by way of example, Germany. Now Germany obviously has the euro, but if Germany was on its own, okay, Germany would have a currency that would be much higher value than it currently is. But because the euro integrates rich and poorer countries, it's artificially low for a country like Germany. So Germany has been a huge beneficiary of the euro. It's actually one of the biggest exporters in the world after China, because they've become extremely competitive. Now they've reformed a little bit, but frankly, the currency has been the biggest factor in this. The other thing, and you compare that to a country like Portugal, or Spain, or Greece. Well, they're operating with an economy, with a currency that's much too high for their economies. So it's kind of like, you've got a Mercedes, an economy like with a Mercedes with the same currency as one with a Trabant, which is that East European Lada that they used to have, if you remember those cars. So there you see the problem structurally. And this is part of the problem with Europe. And then we have Brexit. And Brexit, as I was saying, we don't know what it's going to look like. So what this says here, you probably can't read it, but it says, "Pardon me, sir, may I suggest you take a parachute with you?" And he says, "Thanks, the flag will do." And so I think this kind of summarizes what Britain has embarked on. Their vote was very much anti-establishment, was very much anti-elite, and very, very sovereigntist, right? What no one really talked about during that debate was the fact that Britain had the best of all worlds, because they didn't have that euro currency. They had access to the markets, right? They had free access to Europe, which is world's biggest trading bloc, and yet they could devalue. So after the crisis, they devalued. No one said anything, right? They actually had a very mild recession. And no one ever brought that forward to the UK. Now, we don't know what's going to happen. I mean, a hard Brexit basically means that they will cut off everything with Europe. And the problem is that everyone talks about, signing a side agreement, like Switzerland or like Norway. But the problem with even those two countries that have signed access to Europe, by the way, they also pay into the European budget, but they also have to adhere to the principles of Europe. And the founding principles of Europe is free movement of labor, free movement of capital, and free movement of goods and services. So it means that if for instance, I have a French passport, I can move to Norway tomorrow without any questions asked. I can move to Switzerland tomorrow, no questions asked. So if England wants to have the same agreement, they have to agree to the same thing. And that's what they voted against. So you can see what position they're in. And now you're seeing how difficult it is to sign new agreements, new trade agreements. And those trade agreements, by the way, they don't take a year. They take 10 years. So Britain could really be out in the cold, without talking about what the impact it's going to have on the rest of Europe. Because Shaun mentioned the migrants. Well, the migrants, have been resolved only temporarily, because these migrants who've come from Syria, from Ethiopia, from Somalia, from all parts of the world, Afghanistan, Iraq, they've been now funneled into Turkey, that now has about 2.5 million of them. But that agreement is very fragile. And because Erdogan is basically repressing his people after the failed coup of this summer, he's getting a lot of pressure from Europe. And so the pressures there means that this could unravel very quickly. And you could have 2 million people walking into Europe. That would fuel this populist measures. And next year we have a number of elections. We already have a referendum in Italy to basically simplify the government in December. That will likely fail, unfortunately. We have elections in France, presidential elections in France, elections in Germany, and elections in Holland. All of them could see a rise in populist parties, and there's the problem we have. So we have trouble being very, very positive on Europe. Now, let me talk about just Canada quickly and oil, because Canadian dollar, I think, we're all kind of close to oil in one form or another, and for some reason the Canadian dollar seems to follow oil one way or the other. Now, we're relatively positive on oil. We do think that things are improving and that we'll get back to the $50, $55 range. We're around 46 today, in US dollars, that is. But we're not going back to $100. And you have to sort of recognize that one of the reasons we're not going back to $100 is that the US is now the world's swing producer. And you're not far from the Dakotas, and I'm sure you've seen or heard of some of this shale oil and gas, but essentially that is the difference. And I'll just put it this way, for a long time, Saudi Arabia was the world's swing producer, in spite of the fact that it's also the world's low-cost producer, because it was the only country with really excess capacity. So Saudi Arabia could lower its capacity, lower its production, and actually manipulate prices up. But at $100 oil and up, it stimulated a lot of investment. And because of processes, of technology improving, it was very profitable investments. So the oil sands in Canada, deep water drilling off of Gulf of Mexico, Brazil, very profitable, as well as shale oil and gas. But the difference between shale oil and gas and the others is really the nature of those operations. So you may be aware, because you're not far from it, but that shale oil and gas is a drive-in, drive-out operation. You drill for a few weeks, you tie in your gas or your oil, and you get your cash flow. Well, you compare that to the tar sands, or the oil sands, I should say oil sands, of Canada, and Fort Hills, which is a project between Teck and Suncor. That's a $7 billion project over 8 years before you get $1 cash flow. They're still building. In Dakotas, you can go through right now, there's nothing happening. A friend of mine went from London, Ontario to Calgary and drove through the Dakotas. He says there are 400 people camped there, empty, one pickup truck. But I can guarantee you one thing, as the price comes back up, those drills will come back, those camps will start getting going again, and the production will start moving up again. So what that means is that now it's the US as the swing producer. And so it will cap any rise in the rate, and it will cap new capex and new development in Western Canada, and new development in a lot of the deep water drilling for a number of years. And I say a number of years because eventually it will catch up. Because we have basically, in the last couple of years, budgets, in other words, budgets of big companies worldwide have come down to about $50 billion. That's $50 billion that has not been invested. And next year, those budgets are going down another $20 billion. That's $20 billion more dollars that will not be invested. And every single oil and gas rig, its production goes down every single year. A little bit, some a lot, some a little. And the only way you limit that decline is by investment. So eventually, this will rebound. Because high oil prices kill high oil prices, and low oil prices eventually kill low oil prices. It's just that this one's going to take longer because of the US shale oil and gas. And because of the swing capability. But they don't have the ability to really change the world. Like, in other words, we're talking 1 or 2 million barrels a day. So the point I'm making is that over a number of years, prices will eventually make it back up. But right now, we're facing a glut. We're facing a glut because we've had too much oil come back from Iran, from Iraq, from Libya, depending on the day, Nigeria, and all these other places, and we have too much inventory. So listen, that kind of, I think I've hit my time. I have 1 minute. Look, I've got a lot of things I can talk about, but I don't want to bore you. So I'd rather take a couple of questions, and if you have any questions that you might have, to respond to it and not go into more detail on any one of these.
Okay, JP, thanks so much. So a lot of material in a short period of time. Lots of interconnection between all those different themes. So I'm going to start with a question, but here's what we want to do. If it's not often we have an opportunity to have someone like JP as a global strategist in front of us to address questions. So I'm going to ask a question, but maybe reflect on a question you might have. There's no bad question, no silly question. Likely, if you have a question, there are people in this room that have the same kind of question. So I'd encourage you to think about it, and we'll take a few questions, and hopefully it'll give a little more context and a little more shed a light on a few more topics as well. So here's my question, JP. It actually relates to oil prices. So obviously we live in a country where, if you look specifically at Newfoundland, Alberta, and you look at federally, our federal government really relies on resource and resource revenues. If in fact we're in this long-term slow, sluggish uptick in oil prices, do you have a perspective on what it means to various provincial governments or federally, the impacts potentially? And I know that's coming out of the left field for you, but if you have a thought on that, would be great.
Yeah, so I think one of the impacts that we don't know or we can't really fully appreciate is just how much it's benefited the rest of the country. I mean, I go to the East Coast quite a bit, and on a lot of my flights, I notice that these guys, they're usually quite a bit bigger than me, and with just a backpack, and they're coming back to Fort McMurray. And so, many of these people have had some really high-paying jobs. Often their trips paid for by the companies, and they were repatriating that money back to their communities through, hired truck sale, buying a truck, renovating their houses, whatnot. And so we don't really fully underappreciate what the impact of that will be, because many of those jobs are finished or certainly have been reduced dramatically. And my understanding, in speaking with some of these people who know, is that before the companies used to pay for the trip, now they don't pay for it anymore. And it's usually about a $900 fare to go from basically a Moncton to Fort McMurray, just to give you a sense. So that's one impact. The other one is that I do think activity will come back slowly for existing operations. So in any of these operations, because I was talking about, they're huge investments up front. One has to take massive investments up front. But once they're built, all you're worried about is really what is the cash flow that it's giving me on what I have, and what do I need to invest in just to keep the operations going, and obviously my equipment up to date. So I think there is where I'm a little more optimistic. And the other one that's gives me a little more optimism is that a lot of companies, that because of these lower rates that we've had until very recently, many companies have issued quite a bit of debt as well as quite a bit of equity in order to essentially buy themselves time and invest. So we actually like some of the oil service stocks because we think that activity will come back. So it's not, we do think that things are slowly going to come back, but again, it's not going to be anything like what we experienced before the fall in the oil prices. So it's just a stabilization, frankly.
Okay, thank you. So if you have a question, just put up your hand. I'll see if I can get to you here.
Somebody over there.
Do it in here because it'll pick up the recording too. So.
Okay, you talked a lot about the geopolitical environment that we find ourselves in with Europe and the U.S. and oil, but you haven't talked at all, or you haven't mentioned gold. And I'm wondering where you think all of this is going to impact gold.
So let me give you a quick answer. I have no clue. No. So this is a really interesting point, because it's something that's I'm quite close to, and actually I try to study a lot. Gold has behaved very well when the situation looked like it wasn't good. In other words, when it looked like we were going to come out with more QE, more unconventional measures. And that's what happened earlier this year, right? Before the BREXIT, gold actually recovered quite a bit. And since then, it's fallen because the markets have decided or thought that we were going to come back to normalcy. We're coming back to some sort of equilibrium. My argument here is that we're likely, and I think, again, over a number of years, actually going to go towards slightly more inflation, that central banks will want that slightly higher inflation because that's one of the ways that you can actually lower the real debt. Deflation is the worst thing for debt. With deflation, you revalue your debt. With inflation, you devalue your debt. So you benefit, basically, debt holders with inflation. And I think that that's ultimately what central banks will want, and I think, therefore, that gold will recover. The timing of that is unknown to me, because I think we need to have some sort of resolution with respect to where these rates go and how far the market will allow them to, and how far central banks will allow them to go up. So again, recently the markets has been anticipating, and the reason gold's come down is it's anticipating the fact that we're going back to something more normal, because fiscal policy is going to be an impetus, and therefore rates can go higher. But my point is that I think that there's a shift that needs to be shaken out, or that needs to be understood by markets, whereby, in fact, we're going to a slightly more inflationary, period than what the market is expecting, with continued low real interest rates. And over long periods of time, history shows that it's real interest rates that matter. And the real interest rate is basically what you see in a rate of interest, less inflation. Right? So if inflation goes up and the rates stay the same, the real rate actually goes down, because it's less inflation. So that's my take, but again, it's not being proven out, and I wouldn't be going into gold today. I would wait and see how this pans out and see if I'm right, because I'm not 100% sure.
Okay, thanks, JP. Another question?
We have one back there.
Okay, where?
Right over there in the back as well.
And I'll go back to the room
Yeah,
at the back.
There's somebody in the back as well.
I wonder if you could just expand and offer your perspective on, more broadly, on technological change and technological disruption. There was an editorial in The Economist magazine that said in next 15 years, fully 85% of jobs that exist today as a consequence of automation and artificial intelligence will not exist. That would seem to have enormous impact.
Yeah, no, I think that's a very good point. And certainly, part of this is globalization, but it's also been enabled with technology. And in fact, what we're going to see is, just as you say, we're on the cusp of artificial intelligence and machine learning, whereby it will go into, I'd say, eat into the next level of jobs that are qualified jobs. And so this has to be a huge concern. And I think, there's a lot of debate. In fact, there's been a lot of debate about universal minimum benefits, which is essentially, in fact, Switzerland had a referendum earlier this year on that very topic, which is essentially to say we get rid of all our social programs and we give everybody a check. And so, I mean, these are the sort of things that are being talked about in order to address the very point that you're making, which is that hundreds of thousands of jobs are likely to be lost. And if you think about just the autonomous car, and some of the technology that Google's come up with by just being able to move boxes with robots, and being able to selectively find the box and put it in the right place, and this one in the right place. I mean, just the amount of manual labor involved in transport, between the FedEx drivers, the transport drivers, the delivery drivers. I mean, there are hundreds of thousands of jobs. So it's a real issue. And I would say that's one of actually the biggest deflationary forces that we face. And there's structural forces out there that are very, very, that are very, very large, that will be hard to offset. What we have short term is this ability probably to try and offset it with fiscal policy, and that's what I think the attempt here is. But the longer term is clearly in question, and frankly scary. And it's not that we haven't had these periods before. I mean, the agrarian society, and I think you're probably historically well positioned to know. I mean, we went from an agrarian society to an industrial society, but that took place over decades. This is happening over years, and it's the pace of that change that makes it extremely difficult. And I think with social media and with the changes in media and it's a much more dangerous political situation because of this nativism and these changes in the United States, where you can't even agree on the facts. You can't have a coherent discussion because you can't agree on what the facts are. And so we've lost, at least in parts of the Western world, and the United States in particular, this ability to actually rationalize and to make sense of these changes, because they're happening so quickly, and because people are getting information from all sorts of different areas, often what they want to hear, and that gets reinforced with the algorithms that will feed them what they want. And that's really it's a huge, huge, huge issue. And you can see that Google, Facebook are starting to, well, just beginning to talk about it.
Great, thanks, JP. We'll take one more question. Does somebody at the back have a question?
There was somebody in the back there, yeah.
Oh, great.
You may have answered it already, actually, about inflation. Can you prognosticate a little bit more about inflation and interest rates? And I think you talked about inflation, so maybe more on interest rates if we have the time. And
sure.
If you haven't really answered that question earlier, I thought you may have.
So my prognosis here is that we'll get some higher levels of interest rates in the long end. But they cannot go up dramatically given the debt levels without it having a negative impact on the economy. So we can absorb some of these higher rates with higher growth, but to a limit. And so I think this is what is going on, and I think it's what's going to be happening for the next couple of years. Now, beyond that, because of the structural forces that we just discussed, I don't know. And I think you can't really know. But I think that this is this is the change that's happened since Trump got elected. And I do think that there's good reason to think that this will happen within limits, because again, I think it's the long rates that could go up, and I'm talking not dramatically here, but the short rates will probably stay very low because central banks will want to keep them lower for longer because of its negative impact on the economy. So as the economy grows, we can probably absorb those higher rates. I'm talking about the United States, but again, to a certain limit. And at some point, and again, it'll depend also on the efficacy of these fiscal stimulus, on the efficacy of lower income taxes. Because Trump also wants to lower income taxes, which honestly will not help this dynamic of rich and poor. I mean, in the United States, the marginal tax rate, he wants to bring that down to, he talked about 25, but we're talking about 33%. But that's considerably lower than in Canada. And today, you only reach that top marginal tax rate at about $430,000 US, which is over 600,000 Canadian. So you can see how much people making that kind of money take home in the United States versus Canada, or for that matter, anywhere else in the Western world, considerably more. So it's not going to help that dynamic or that politics. So I'm just really talking about what we're seeing here for the next couple of years.
Great. Thanks so much, JP. But now, just one second. JP's committed to kind of hang around a little bit, so if you have any burning questions, I know he's prepared to form a scrum later on this evening if you want to pepper him with questions. So, JP, thanks so much for spending time with us, and your presentation was wonderful. Let's give him a big thank you.
Thank you very much. Thank you.
Well, that concludes the presentation, Regime Change. There was a lot of great information there. If you want to talk to your financial advisor with Asante, be sure to contact them. They'd be pleased to review your portfolio and to address any questions that you might have. If you're not a client of Asante, then be sure to reach out to us using the contact information below this video presentation. All the best as you pursue your financial, investment, and wealth planning objectives.